Thanks for joining us for another episode today. Today we wanted to talk a little bit about the common mistakes that we find in financial statements, especially for nonprofits. So a lot of times an auditor assists the organization in preparing the financial statements, but they are really the responsibility of management. And in a lot of instances, organizations will prepare their own financial statements. So we want to touch a little on the mistakes that we find throughout the financial statements to help you improve your financial statements, make sure they're complete, so that way it gives you the best picture of the organization.
So where should we start? First statement of financial position.
First statement.
All right, we'll start there. Start right there. So the statement of financial position. If you remember from one of our previous videos, this is also the balance sheet. In the for-profit world. So in the statement of financial position, we're listing our assets, our liabilities, our net assets, and one of the things we do see fairly common is when looking at groupings for the assets, it's kind of all out of order. And when I say out of order, I mean by liquidity. So how it should be listed is the most liquid, so usually cash, at the very top, and then you go down based on liquidity. It's done this way just so it's easy for a reader to come in. They can easily see your most liquid assets, your cash, your receivables, investments, things of that nature, and all the way down to the bottom of your most non-liquid, fixed assets, things of that nature.
Mm-hmm. Yeah. So one specific thing for nonprofits is a lot of times your cash balances or your investment balances could be restricted. So if a donor gives you money for a specific purpose or for a specific program and you haven't spent it yet, you may have restrictions within those balances, or say an endowment. If someone gave you money for an endowment for the organization and those funds are sitting within your cash balance, well then they are no longer very liquid. So you do need to take that into account when you're doing the balance sheet and the presentation there.
Yeah, those restrictions can definitely change things for you.
Mm-hmm.
So in another area, and this also kind of helps segue into the statement of activities, is your deferred revenue. And what I mean by that in this situation for nonprofits is when you're looking at your grants sometimes have conditions. Won't go into all the ins and outs on what's conditional versus unconditional. We did speak about that in another video. But essentially, if you have condition, now that revenue, what should be revenue, now sits on the balance sheet as deferred revenue, and that can't be recognized until those conditions have been overcome. So we see this a lot where an organization receives a grant, it's conditional, but we find it in the P&L where it doesn't belong.
Mm-hmm. Or vice versa, where I see it more often where it's in deferred revenue, where it should be recognized as revenue because there really were no conditions. And it's important to remember that conditions are different than donor restrictions.
Right.
So if you need more clarity on that, reach out to us anytime.
Or watch our other videos. And this is also a big area because this really impacts your revenue, your liabilities. This could really impact another reader's viewpoint of your financial statements. So it's definitely a big area to be mindful of.
Mm-hmm. So that kind of segues us into the statement of activities for an organization. That's where you're going to see your revenue and expenses. So it's important to classify all of your revenue categories into whether they are considered exchange transactions or whether they are contributions. So again, contributions and grants are very nonprofit specific. Mm-hmm. You should group all of those different revenue streams appropriately. You don't want to mix exchange transactions with contributions. So they should be separate on the statement of activities. And then you'll also want to make sure that any donor restrictions are presented properly in the column where it says with donor restrictions. So if you look at a statement of activities for a nonprofit organization, you usually get 3 columns there where you have your total revenue and expenses, but then you allocate between the with and without donor restrictions.
And it's very important as nonprofits to really follow the donor's intent, so that with and without donor restriction columns is a very important area.
Mm-hmm. Even your investment income. So if you have investment income and it's on an endowment or a restricted asset, you want to make sure that it's in the right column for with and without donor restrictions as well.
So another area is in-kind. You okay if I take this one?
Sure.
So in-kind. This is, I see this a lot, where nonprofits, organizations, recognize the in-kind donation from volunteer hours. So how in-kind works is for professional services, let's say an attorney provides, pro bono work, free legal services, you could recognize that as income, in-kind income, donated services, and professional fees, legal expenses, it nets out to zero. That's due to the fact that you're going out and using a professional to provide their professional services. Now, with volunteers who are just, providing their time, doing various activities according to the mission,
Or helping with an event.
Anything of that sort, but they're not using their professional backgrounds, that is no longer considered in-kind. So you can have that same attorney, but now they're helping with events. That's no longer in-kind revenue for the organization. So that's an area I see a lot where organizations sum up all the volunteer hours, come up what the hourly rate is, and then recognize that on the statements. And that's really not accurate for nonprofits. Now, with that said, your volunteers and your volunteer hours are very important. They're very vital to an organization. You could definitely put them in your footnotes, in your disclosures, mention you have all these volunteer hours. They're very vital to the organization. You just can't recognize the revenue and expenses of those in-kinds. Unless, as I mentioned, it's for professional services.
And then there are certain disclosures around your in-kind, or sometimes now with the new standards we call them non-financial contributions. There are certain disclosures around that too that you'll want to make sure you include all the right elements. Like you have to include what it's being used for, if it's for program or if it's for G&A, and how you're valuing those in-kind donations. So those are important disclosures as well.
And those are new disclosures, as April mentioned. So it's even more common nowadays to find that missing or omitted. And like I mentioned before, a user's looking at these statements, they're now expecting this information. You want to make sure your statements are as accurate as possible.
Right. So now you have your expenses for an organization. So the standards require that you show your expenses in their natural classification. So that's like salaries, office expenses, rent. And then you also need to include the functional allocation. So the standard says that it can be on the face of the statement of activities if you wanted, depending how large your organization is and how many different categories of expenses you have. Or it needs to be a separate statement, so you can have a statement of functional expenses as well, or even in the footnotes to the financials. So you do have a couple options there, but the standards require that you show all of the expenses in one spot. So even if you net some of those expenses on your statement of activities for the revenue, say like special events, a lot of times you will net the donor received benefits against the special events. You still want to include those expenses with all of the other expenses in one place. So you have to make sure that that's presented properly.
That's a very common area you mentioned. So a lot of times we look at a statement, there's special event, revenue, there's donor received benefits, April mentioned, but then when you look on the functional expenses, it's not listed there also. So it's supposed to be listed there and then backed out, which is weird a little bit, I guess, but it's trying to show all the expenses in one spot and then netting it back out to how it's shown on the statement of activities. Now, there's one exception to that, and that's your investment fees. So any investment expenses get netted against your investment income, but are not shown in your functional expenses. That's the one exception to that.
True. When it comes to your net assets, it's kind of tied into your statement of financial position, but again, important with your net assets. You do have to make sure that you're showing the right amount of detail in terms of any restrictions or board designated amounts. So you want to make sure that there's enough detail there for the reader.
And that could be shown right on the face of the statement of financial position. However, you don't have to. There are other options. You just show that now and disclose that in the footnotes. So you do have some options how you want to go about it, but that information does need to be available somewhere in your statements.
Okay. So I think that brings us to our disclosures.
I think so.
Okay.
So one footnote that's required for nonprofits that I sometimes see missing or omitted or maybe not presented correctly is liquidity disclosure. So nonprofits have a special requirement where they're required to disclose to the reader their liquidity. And when I say liquidity, it's all your, current assets, your cash, your receivables, investments. And then what you're supposed to do is back out anything restricted. So as April mentioned earlier, on the statements, any restricted cash or restricted assets, usually show that separately. It's kind of broken out for liquidity purposes. So when you're doing this footnote, you're kind of showing everything all together, and then you're backing out anything restricted or anything not able to be used within the next year. Just trying to provide the reader that information of, all right, within the next year, this is how much in assets we have available to spend within our normal operations.
Yeah, and it's an important disclosure for nonprofits because the restrictions are common.
Yeah.
Where you have assets or cash that you're holding on to, but it's owed back to a grant agency. So things like that can really affect the cash balances and liquidity of the organization.
And just another point to bring up about this footnote, the reason for it, as we're kind of mentioning here, restrictions can be confusing. It may not always be clear. So the point of this footnote is really make it clear to the reader, all right, this is what we truly have after restrictions. This is what our true liquidity is, and make it very obvious.
Endowments are really specific for nonprofits. A lot of times we find that the disclosures are missing some of the required elements. So things like your spending policy, whether or not the endowments are underwater. The market can change significantly year over year, so it's important to make sure that you've got all those right disclosures. So they are long, they are lengthy for endowments, but sometimes we find that they're missing some of the required pieces.
Right. So I think at this point, we'll move away from the nonprofit specific and go towards the general mistakes that we sometimes find. So one in particular is the lease footnotes. So this is a fairly new area within the past couple of years that now leases are required to be put on the face of the balance sheet or statement of financial position, and then there's required footnotes to go along with that. So I see this a lot where some of those footnotes are missing. So, for leases, you're required to show the weighted average of the remaining useful life of the lease term. You're supposed to show the weighted average of the interest rates that are discounting the lease. You're supposed to provide information about the options, so if you could extend the lease further past the current lease term, things of that nature. There are unfortunately a number of required disclosures for leases, and I commonly see that not fully all being there presented to the reader.
Yeah, that's a really good point.
Yeah.
Okay. And sometimes there is missing elements in the debt footnotes. So whenever there's mortgages, loans, debt for the organization, there are required disclosures there as well in terms of the collateral, the interest rate, what the terms are, the maturity date. Sometimes we find some of those elements missing as well.
And then one last area, so bad debt. So on the statement of cash flow, you're required to show bad debt as a reconciling item from operating activities. So when you're looking at the cash flow statement, when you're looking at receivables, that shouldn't be shown net of bad debt. The bad debt is taken out and put above your change in assets.
Yeah, that's a really good point. A lot of times that gets net with your change in receivables.
Yeah.
Okay.
We see a lot.
We've seen a lot of financials. So one thing that's really important to note, just the overall principles on the financial statements, is that they are management's financials. A lot of times we assist in the preparation of them. But when you are preparing a financial statement for an organization, you do have to evaluate going concern. So sometimes the wording gets a little funky with the meaning behind it, but basically financial statements are prepared under the concept that the organization is going to continue for well over a year from the date that you're issuing the financial statements. So, and issuing the audit opinion. So it's important that everyone realizes that this is a management evaluation. So they are management's financial statements. So management needs to evaluate the going concern and if there's any substantial doubt or subsequent events, anything that may impact the organization in the sense of it may not still be operating a year from when the audit is being issued. So that's an important element. So sometimes when we are in the middle of an audit, we are mid-fiscal year. So there is often a budget and an evaluation done for that fiscal year, but it does need to be brought out a little further for that 1 year mark. So that's also really important, I think, when it comes to the financial statements. And sometimes if the financials are not strong or there's some financial troubles, you may want to include a management plan footnote. So that's really important for the reader to understand what you're doing to either cut back expenses, restore profitability, any significant changes that you've made subsequent to year end to bring the organization to a more profitable state. That's a really important footnote to include in the financials, I think. And that's kind of all under that going concern evaluation.
No, as April mentioned, that's a really important footnote. That really is your spot where you can really go into depth on what you're doing to turn around the ship. If there's an issue, here are the steps we're doing, here are the plans we have in place to right the ship and get us back on track. So it's definitely a good footnote to put in there if you think there's any third party reading those statements may have concerns. Definitely something to think about.
Right. And then beyond the management plan footnote is if you had to put in a going concern footnote. So the management plan note doesn't necessarily mean there is a going concern. It just wants to give the reader more information if the financial statements are not as strong.
Yep.
So, all right. I think we covered it all.
I think we covered a lot.
So hopefully that gives you some insight into common financial statement mistakes, and hopefully that helps you improve your statements so you can make the best management decisions.
Thanks, everyone.